So a couple things. First of all, Pete, I appreciate your call option on Bank of New York very much. And second of all, I think there are a lot of things that are going to appear fully priced right now. Valuations don't mean as much in this environment as they normally do. We have so much of a backstop from the Fed. We have interest rates at the floor that we don't see going anywhere anytime soon. So I don't know that I would put as much weight on the absolute valuation level or even the relative valuation level if we're looking at history. As far as does this have legs, some of the things that I was worried about in May, and I was wrong about some of this, I was worried in May that the rally would run out of steam because it was based on policy support and not on fundamentals and not on better expectations of growth and earnings. Those expectations still haven't changed, but now what's happening is we're able to start making the bull case come true. So we're starting to reopen. And I said this, I think, on the last time I was on the show, the reopening is innocent until proven guilty. So far, so good. And we're going to have legs unless we get bad news on that front. A lot of this is tied to the virus path, and it is tied to continued doses of hope on both a treatment and a vaccine. And we continue to get those little doses week by week as we go along. I mean, Joe, so the momentum here continues.
Look at where the market was able to get to, Joe, before you had mass reopenings, right? That was all policy. Now, if you want to make a cocktail and you put together, you mix in more reopenings and it's going, let's just assume it goes better than people initially feared, and you combine a couple of shots of policy into that, that's pretty powerful.
It has been powerful, and I think it speaks to your question at the top. What do you do with that recovery trade, as Pete correctly defines it? As we approach the month end, it's obviously going to accelerate. It's going to reach a crescendo. And I believe the risk to reward relationship is not in your favor to remain in those stocks. There are several things, several conditions in the market that I don't like. Why is it that a 10-year Treasury is still trading around 70 basis points if we're going to have this cyclical recovery and an economy that's going to return to normal?
Well, I don't know, Joe. Why I mean, that's kind of obvious, isn't it? Why did rates remain so low for the last decade plus? You had an overwhelming policy response to the Great Recession. You've had an even bigger global one to this. That's why. Even if the economy starts to improve, why should we think that rates are going to move because of all of the central bank policy that's in the market?
That's fair on a secular basis. You're 100% correct, Scott. But there was cyclical moments within the last 10 years where there was an acceleration in growth. Well,
that was very brief,
concurrent
though, right?
With that.
That was very brief, though.
Absolutely. And I said to you, on a secular basis, you're correct. But there's not a concurrent cyclical move that we're seeing in the Treasury market. Additionally, and I'll ask Pete this question, why is it that we have the VIX still trading north of 25 if we are returning to what is being described as normalcy?
Well, we're still in the midst of a pandemic.